Today we get to hear the highly anticipated annual apartment market update from the foremost knowledgeable source, Patrick Berry. If everyone would please welcome him to the stage. Patrick has taken over his father's company, which was started in 1983, specializing in appraising multifamily properties. I think we're all very excited to hear about the past 12 months and what Patrick's feelings are about the next 12 months that we're about to see, 11 months. Patrick, come on up.
Great, thank you. I was joking with someone when we got here. This is a pretty big crowd for today, and I feel like it's either you guys really want to hear about multifamily or you're kind of like me and maybe you have a little more free time on your hands these days. So heading down to Lake Oswego for a talk is a good thing to do on a Wednesday here. So I want to start today at a high level, cover some of the macro trends that we're seeing going on, which is incredibly important right now. I think that's more important than the apartment fundamentals, but understanding what's going on with employment, population, home ownership ratio, interest rates, apartment construction, then move into some of the apartment fundamentals with rent, income, vacancies, expenses, then move on to sales and values, figure out how we fared in 22 and where we're going in 23, and then move on to a few other issues, some political stuff that's going on. So for a moment, try and ignore all the layoffs and all the negative news you've been hearing recently, but let's just focus on where the fundamentals of the economy are right now. Oh, by the way, these are the sources I used. If you're heavily involved in multifamily, I highly recommend this Freddie Mac Multifamily Outlook, largest holder of debt in the US, and they have incredible data that they share in here. So if you're involved in multifamily, take a read here. So again, ignore all those headlines. Let's figure out where we are. Currently, we sit at the US sits at 3.5% unemployment. We're back down to pre-COVID levels. It took us 24 months to get there. We continue to see a record level number of job openings with 10.6 million. I don't know what's going on with that screen, but I'm not sure it's on my laptop. So 10.6 million job openings. That's down about 1 million job openings from 6 months ago, but still at record high levels. Our GDP for the fourth quarter of 2022 was 2.9%. They actually went back and revised the third quarter and bumped it up to 3.3%. So that's incredibly good GDP growth. Now looking at Portland Metro. We're seeing we hit pre-COVID job levels back in August, and we currently sit at about 1.27 million jobs across Portland Metro. Even from November to December 2022, we gained 5,700 jobs. However, today unemployment has bumped up. We bumped up 3.5 6 months ago, and we sit at right around 4% today. This is, so it's kind of misleading. So we're gaining jobs, but we're also increasing unemployment. And we do have, this is the, represents, who's looking for work right now. As you can see in this green line here, this shows the percentage of people new to the workforce. So the amount of people that have re-entered the workforce and are starting now to look for jobs has increased, which is definitely pushing up that overall unemployment ratio, despite us continuing to gain jobs. So this is how our current recovery, the dark blue line, has looked compared to previous recoveries. As you can see, it was a pretty quick recovery. But as we know, while things may look fairly strong today, we definitely have some storm clouds ahead. This is just news articles from the past week about some of the layoffs that will be occurring within Portland Metro. I'm not sure if you guys saw, we had Intel, big news yesterday. Layoffs at Umpqua, we had Gunderson Train, Vacasa. It seems like every day we opened up and there's a new announcements of layoffs that will be coming down the line. And because of that, the Oregon Office of Economic Analysis has come out with their new forecast. This was in December of 22, and they're forecasting that starting in the third quarter of 23, we're going to start shedding jobs, and we're going to lose about 24,000 jobs. We're going to hit 4.4% unemployment by the end of this year, and then reach 5.4% unemployment by the end of next year. Inflation is an obvious challenge. It's improving. I think we've turned the corner, The most recent report showed inflation at about 6.5% year over year. It actually showed negative inflation month over month, which is definitely an improvement. There's not a whole lot of good things about the inflation, but the only good thing that came out of it was the fact that the new maximum rent increase for 2023 was bumped up to 14.6%, which is driven by inflation. And we expect that number to remain elevated for next year, somewhere, I've heard between 10 and 12% for next year, if inflation stays. So I want to look at what's driving this market. First we talked about unemployment, and the next one I'm going to talk about is population growth. And I'm not trying to be dramatic here, but this is a very concerning figures that have come out recently. For years and years that the state economists were forecasting population growth somewhere between 20 and 30,000 for Portland Metro, and then somewhere between 25 and 40,000 for the foreseeable future for the state of Oregon. I'm not sure if you guys caught it, but back in December, the census numbers came out, and they actually showed Portland as one of the 10 states with the fastest declining populations. Census Bureau reported that we lost 17,000 people, or about 0.4% of our population. They haven't really released local data on this. We don't have the county data yet or the city data, and you can make up whatever reason you want for reason why everybody left, but I think it's just not known right now. There's potential reasons. Obviously, there's affordability issues. A lot of work from home. People departed, urban areas, and that includes Portland. And then whatever talking point you want for, the urban area or taxes or whatever there. So here it shows. Dark blue is our decline, and this is a state economist. This is Josh Lehner, who I highly respect, great information. This is what his comment was the day after the population decline came out. He said, this is a 2 or 3 fire alarm, 17,000 net domestic migration. If 2023 doesn't rebound, it's a 5 alarm fire for the economic outlook. So I think as we head into this next year, looking at these population figures is going to be incredibly, incredibly important. I can't stress it enough. If there's any positive news to this, Oregon does not rely on the census data population. They actually rely on the Portland State. They have a population center that all they do is study population growth. And Portland State actually had different figures. They said that we increased our population by about 12,000 last year. It was about 16,000 last year. So we do have a little bit of contradicting information. They look at different indicators. I think the U.S. Census Bureau looks at return addresses on your tax returns, and Portland State more looks at driver's licenses and then other kind of local, more local information rather than federal information. And we also had some good news on the United Van Line study. This comes out every year, and they reported that, it's tough to see it here, but that of all the moves that came into Oregon, 67% were inbound moves and 33% were outbound moves, which is it's a pretty strong number. It's actually the second highest inbound location in the U.S. I think as unemployment continues to push up, you're going to see more and more people, more and more companies recall their workers to the office. City of Portland, starting in April of 2023, is requiring that all employees work 20 hours minimum per week in the offices in downtown Portland. And it was new to me, but they're actually requiring employees actually live in Oregon or Washington. I just assumed that if you work for the city of Portland, obviously you lived in Oregon or Washington, but given the work from home, now you get people who moved out of state who are going to have to make that decision whether to move back to Oregon or Washington or try and find new work. And I can't stress how much it's vital that Portland maintains a high quality of life in order to attract both employers and residents. Starting in the 1990s, we had natural population growth accounted for about 20 to 30% of all growth we had. But based on demographics, that's been declining, and now we actually have reached an inflection point where we have more deaths every year than we have births, and we have no natural population growth. So we rely 100% on migration. So even if we want to stay flat in population, we still have to attract those people. So it's, I'll talk about it more later, but it's more than vital that we remain competitive on a national scale, both for employers and for residents. Next thing I want to move on to is the home ownership ratio. All those higher vacancies that we had leading up to the Great Recession, none of that was caused by oversupply of new units on market. That was simply caused by a shift towards home ownership ratio, or home ownership. We peaked at somewhere around 66.5% home ownership. We then fell to 61%, and we've climbed back up to about 65.5%. I don't see this climbing too much farther beyond this point, given the challenges with the affordability, now with interest rates where they are. Hard to believe, I'm not sure many people in here are currently looking for a house, but as of January 1st of 2022, so about a year ago, interest rates were at 3.55%. Today they're at 6.15%. And if you had a budget of $2,500 a month for housing, that translates, a year ago, that translates into a loan of $550. And today that translates into a loan of $410. So you can see just how it's impacting some of these buyers. And that whole rent versus own calculation has swung back towards the renters. This chart shows the, I'm not an expert by any means on home values. I've never appraised a single family home in my life. But this chart shows home prices versus median income. Yeah, I'm not sure what's happening with the presentation here, but this shows home price to median income. And you can see, this is a bit dated, but back in December, we were somewhere around, approaching 8% on that ratio. So you can see historically we've been maybe in that 4 to 6% range. So we definitely have some room to come down in terms of price to home ownership or price to income. So now taking a look at interest rates. So I was here in May, and the Fed had just announced their second rate increase. It was 50 basis points, and we were approaching 5% average interest rate on the 30-year mortgage. Since that time, we peaked at over 7%, and we're now approaching about 6% on the 30-year interest. We actually had another increase today of 25 basis points that happened earlier today. And when I spoke last year, I kind of made the comment that for most of us in this room who are, I'd call us real estate servicers, we all had a killer 21. This is from appraisers to lenders to mortgage brokers to general contractors, subcontractors, developers. It was all an incredible 2021. And a lot of that momentum carried into 22. But I think that we saw as interest rates, as they quickly climbed up, of just how these rising interest rates can really paralyze a market. And I'm sure that all of your fourth quarter, did not reflect what your first, second, and third quarter looked like. And I'm sure that's carried into the first quarter of 23 as well. I was at a appraisal institute conference in October, and a prominent apartment broker got up and he said that it felt like it was that time of year when the teacher says pencils down on the test, that the last 2 months of the year, not really much was going to happen. And I think his prediction was pretty true as we ended last year pretty slow. So this is the 10-year Treasury. We peaked at 4.25%. Since that time, we've come back down to about 3.55%. And the reason I care about the 10-year Treasury is because a lot of overall capitalization rates are going to be based on a spread between the 10-year Treasury. As you can see here, I think this is a chart. I want to say it's Marcus and Millichap. But the top line is going to be the multifamily cap rates, and the bottom line is going to be the 10-year Treasury. And you can see that space in between. I call that the spread. And the spread is, the 10-year average on the spread is about 375 basis points. The 5-year average is about 350 basis points. And we currently sit about 150 basis point spread between multifamily cap rates and the 10-year Treasury. I think if we stay elevated on that 10-year Treasury, it's just hard to find a reason why the cap rates would not be, feeling some upward pressure and increasing in the near future. So moving on to apartment construction, we hit rock bottom in 2009 with permits for just over 1,000 units. We peaked in 2017, leading up to the passage of inclusionary zoning. And since 2015, our apartment inventory has increased about 20%. For this past year, we had permits issued for 6,100 units over here, which is pretty typical of where we've been for 20 and 21. But I want you to notice this trend. The blue line, the blue line gets smaller and smaller. You see the blue line here. This represents the share permits in Multnomah County. In most years, it represents somewhere between maybe 40 and 60% of all permitted units. But as we move beyond 2019, you can see the share of permits in Multnomah County has really declined, and now some of these suburban areas represent the majority of apartments permitted throughout Portland Metro. Currently, we have about 10,000 units under construction across Portland Metro. This is well below previous peaks that we saw, which looking back is now probably going to be a good thing. In general, across the United States, apartment completions at an all-time high, which is a bit problematic going into a period of economic uncertainty. But I've never been happy about the challenges with permitting in Portland, but I think this is one time that it may benefit us, as the developers were not able to get out the record level number of units, and as we enter some challenges coming up in the near future, that we may not have a period of overdevelopment. So moving on to some of the apartment fundamentals. No question, 2021 was an owner's market. As we entered 2022, we started that transition from an owner's market to more of a market in balance. Now, pre-COVID, vacancy rates were somewhere between 4 and 5.5%. Today, most surveys have us somewhere between 4 and 5%. Some variation based on when the new units are counted. CoStar has overall vacancies at 5.5%, but this includes brand new units. And if you break out the brand new units, let's see here, you're going to have they're at about 7% for brand new units. And if you look just at stabilized units that are older than 3 years, stabilized vacancies are closer to 4.7%. Multifamily Northwest they only consider stable units. They're at 3.6% vacancy. The 5 urban submarkets are 4.3, the suburban 3.3, no big surprise there. Lowest submarkets are Milwaukee, Beaverton, and Aloha. I think this is a great chart. It's got a lot going on, but it really shows us why vacancy rates are going to increase in the near future. As you can see down here, the blue bars are going to be net deliveries. The orange bars are going to be absorption. And CoStar is forecasting that for the next 2 years, we're going to have net deliveries that are going to be outpacing absorption. And that's what's going to push up this vacancy rate here in green from about 5.5 today to about 6.75. But take note that that's all units, including brand new units that just finished up. They're immediately counted. And this is what I was talking about, how nationally. So in general, Portland has paced pretty well with nationally where vacancy rates are. But given some of the challenges that we have in bringing units to market, we're going to hopefully experience some better vacancy rates coming up in the near future. Actually, about 125 basis points better than national vacancy rates. Here, this was always a big surprise to everybody. We had about 10,000 units that were absorbed post-COVID. I think it came as a surprise to most people involved with apartments that we were able to absorb so many units in such a short period of time. I think now we know that this has nothing to do with population growth, and it had everything to do with household formation. This is a lot of that 20 to 39-year-olds. They finally felt confident enough in their jobs where they could either move out of their parents' house or maybe split from that roommate that they've been stuck with during COVID and get their own place. And this is kind of how it played out. So from 2019 to 2021, Oregon added 53,000 new households. During that same time, we completed 28,500 new housing units. So that's what pushed that vacancy rate down. And just in Portland Metro, we added 37,500 new households. At the same time, we only added 29,000 new housing units. So that puts us short about 8,200 new units just from the past 3 years. I think as we all have heard, Tina Kotek has made it a major priority of hers to increase housing supply. She wants to go from about 20,000 today to 36,000 new units per year. This is a chart from Josh Lehner at the Oregon Office of Economic Analysis. This kind of shows where the light blue line shows where we would have to be in terms of completions completions through 2040 to make up some of that pent-up demand that we have right now for new units. And the dark blue line is where we actually have been for the past. It's actually where they're forecasting us to be. I applaud Tina Kotek and also Ted Wheeler. They're really making an effort to get it out there that housing and livability are main priorities for the coming years. Details have been spare, but I do appreciate that they had some Senate committee hearings and they invited developers, everybody from the private world, to let them know how they think would be the best way to deliver 36,000 units a year. And it was an article on Oregon Live, just came out a couple weeks ago. But good article. They talked about obviously streamlining the process of permitting. One developer talked about permitting modular homes that can be built in a factory and then brought out to site. They talked about a pre-approved floor plan through the state. It was all pre-approved, that then could be placed on any residential lot in the state and require no local reviews because it's already been reviewed at the state level. I thought that was an interesting one. There was talk about eliminating the public comment process for projects that don't require any kind of variances, and then also relaxing regulations to entice back some of those developers that have made the conscious decision that Portland is no longer a consideration for them. So moving on to rent, I want to talk about rent. Take in mind this is not income. I'm talking about rent here. But during 2020, rents were more or less flat. 21 and 22 increases were in the range of about 6 to 10% per year. But in the coming years, we're expected to slow with rent increases averaging somewhere between 2 and 4%. So this is a chart, fascinating information. This is from CoStar. They own a number of apartment marketing websites like apartments.com, and they're actually able to track daily asking rent. This is the daily or average daily asking rent that they track every single day, and this is for 2022. Portland's always been a seasonal market. We tend to run up rents in the spring and summer, and then starting in sometime in the mid-fall, they tend to pull back a little bit, and they'll continue down through winter. No change here. We peaked out in July, and rents have come down. They hit bottom about January 1st, and they've actually been increasing throughout the month of January. This is 1 year. I want to pull this back to 5 years just to give you a little bit of perspective here. So you can easily see the cyclical nature of rents here. Things got a little screwed up during COVID, but they return right back to their normal pattern. But I want you to keep in mind, so we have pulled back. It's been a bigger pullback than normal. But keep in mind how quickly we've increased in rents. So it took us 3 years to go from $1.60 to $1.70 per square foot average. It took us 18 months to go from $1.70 to $1.95 per square foot in rent. So I think if we have some pullback from those peaks, it's really not going to be that surprising to anybody. And this trend is happening across the Pacific Northwest. As you can see here, again, Portland had a lower high than a lot of these cities, but we're also we did not decline as much as many of these cities as well. So concessions are here. I'd say that concessions are still really being used to expedite stabilization, or maybe on 1 or 2 units that have been frustratingly vacant for a long time, and an owner throws a concession on there just to get it leased quickly. Some of these may not be real concessions. These may be marketing tactics where they throw a real high rent out there and then give you 2 months free, but really it's the same in the end. So this is one over in Northeast Portland that's offering a month free. I just pulled these yesterday. This is one in Northeast Portland, outer Northeast Portland, that's offering no deposit, 1 week free, $100 gift card. This is 2 weeks free on a property out in Beaverton. This is a month over in Gladstone. And then this is 6 weeks on a recently completed apartment up in Ridgefield. So no slide on this, but talk about income and expenses briefly. Income 2021 was a strong year. Across my appraisals, I did an average. It was about 5.4% average income increase from 2020 to 2021. It was a little bit skewed because some people had really low collections in 2020, and then 2021 kind of made an artificially high jump. 2022 numbers, they're also fairly strong, the year started off stronger, and then it weakened, it softened up as we went through the year. I went through my last 30 appraisals that I did on stabilized properties, and the average change from 21 to 22 was about 4.2% increase in income. So, keep in mind here that rents don't always track with income collections. Your rents may be way up, but income is not always up as much as rents. Expenses, luckily for years, there wasn't much to say, but starting about 21, there was definitely some changes. Taxes came out from Multnomah County in October, and I think we finally saw some relief. It was up 1.7% in Multnomah County, 2.2 to 4% up in Washington County, and then Clackamas County was up 3 to 7%. Repair and maintenance, this is still a challenging issue. Wages are still way up. We're seeing some better supply chain issues. I've heard complaints about appliances recently, about them being way out. Labor costs will remain high, but I think a lot of those turnaround times have come down. Management, I've seen no substantial changes here, but keep in mind that we've also seen a pretty big run up in income and rents, and their income is tied directly to that, so that hasn't changed much percentage-wise, but their gross number has changed. Insurance up across the board. I feel like I rarely see anything less than maybe $275 per unit per year on insurance, and now the normal range maybe goes up to $400 per unit per year. Utilities, I'd say they're up 8 to 10% in the past year. So politics in Portland, it's after rent control and after inclusionary zoning, we had a lull where there wasn't a whole lot of political issues involving renters, outside of maybe some COVID regulations that passed. I thought it was, I think this year is going to change. I think there's so much focus on housing that I think there has to be some kind of activity on the regulation side. And I think it was telling to me when Willamette Week, I'm not sure if anybody read it, but it was a great article. They compared Portland to about 8 or 9 other cities that we really are similar to demographic-wise. And they went through about 20 or 30 different indicators from number of police per population, crime, taxes, all this stuff. And I think if you have Willamette Week, who's probably leans progressive, if they're saying that they found reason to worry, I think that's a sign to Portland that maybe we have a few issues going on that have to be dealt with. This was just the marginal tax rate of us compared to other cities. This is the marginal tax rate for Portland at the very top. When you include the state income tax, they also include the TriMet tax and the preschool tax and the supportive housing tax. And now we're talking about, we start adding on some of these. When you add up all these taxes, you get to 14.7%. So that's one issue, obviously. And then we had a surge of evictions, which I'm not sure it's a surprise, given that we kicked the can down the road for 2 years on evictions, that we all of a sudden have a surge of evictions. And with this surge of evictions have all of a sudden come some new concerns. There is talk, well, I guess it's on the ballot now. It's going to be on the ballot in May, a capital gains tax of 0.75% on capital gains in Multnomah County. And that money would go towards funding attorneys for eviction defense. And then just 2 days ago, I didn't know it was coming, but I guess there's proposing a bill that a lot of the protections that were in place to prevent evictions for non-payment during COVID, they want to make those permanent. This is mainly the 60-day relief you have from an eviction while you're in the process of applying for aid. So this is considered to be bring back permanently, which will be discussed later this year. And then we've had some other changes that impact new development, mainly with the air conditioning, that projects permitted, I think, after April 1st of 2024 are going to require air conditioning. And now there's discussion of requiring electric vehicle chargers at all new developments that include parking. Again, we've had a lot of talk from Wheeler, Kotek, and the City Council about what they hope to do. I just hope that we can see some action in the coming year, because I think we're reaching a point where we're digging ourselves a hole and it's getting harder and harder every single year to dig ourselves out. And if you want to find some quantifiable data about kind of where we've fallen or how we're viewed nationally, I think this is a great one to look at. This is the ULI rankings. The Urban Land Institute. The first one is the Survey of Real Estate Professionals across the country. So in 2020, But keep in mind that the report published in 2020 was based on what happened in 2019. But in 2020, we were number 20 nationally for real estate prospects. We fell to 66, 49, and now we're sitting at 56. And then when they surveyed only local participants, we were actually number 1 in 2020. We fell to 63, to 68, and now we're sitting at 74. The only towns below us are Oakland, Buffalo, Honolulu, Hartford, and San Francisco. And I guess my concern is that from 2013 to 2019, Portland was kind of this golden goose. It had incredible job growth, incredible population growth, and there wasn't a regulation or tax that could take us off that path of growth. And I think our time as this quirky, kind of weird, affordable outlier, we can't play that card anymore. We're past that. Our livability has definitely decreased. And I think what some local leaders realize is that our entire market is based on investments from outside of Oregon. 75% of all purchases, capital-wise, are made by people who don't live in Oregon or Washington. So we need to continue to attract this capital from outside of our region. And this is what scares me, is that just how far we've fallen on a national perspective here. Okay, moving into apartment sales. This is a little more positive here. Before I get too far into sales, keep in mind that the vast majority of sales that occurred in 2022 obtained financing during this period here, when interest rates were a little bit lower than they are now. So just keep that in mind as we talk about these 2022 sales. I always like to look at sales in two different ways. The number of transactions and then the dollar volume. 2021 was this weird year where with tons of pent-up demand, super low rates, and it's a year that's probably not going to be repeated for a decade or two. We had 315 sales totaling $4.4 billion. It was a record by far, no matter how you want to look at it. Move on to 22. We finished with 227 sales worth $3.1 billion. It's going to be the second or third busiest year of all time, but 80% of that activity, 90% of that activity occurred in the first 3 quarters of the year. So if you average that out, 227 should mean about 19 sales per month. But as we closed out the year, we only had 8 sales of apartments in November. We had 8 in December. And then in January so far, we've had 1 sale. And it just closed on yesterday. It was a 6-unit apartment in Milwaukee. That was the only sale in the entire metro area for January, which makes me a little nervous for moving forward. I'm sure they will pick up. They have to pick up. They can't go anywhere else. But I just don't imagine this being. I just don't imagine this being a V recovery. I imagine it's going to be a slog, to get back to this market activity that we're used to. But on a positive note, per unit values in 22 were up 10% to a median per unit value of $210,000. Per square foot was similar, up to $246 a square foot, which is 9.8% above 21. So those are all good numbers. But when we move into some of these segments, it's definitely kind of a tale of where your property is located and what year it was built. So this is just new units. As you can see here, we basically had no significant change in the median price per unit since about 2016. A lot of the developers in this market right now are merchant builders. They want to build their unit, they want to stabilize it and get it off their books as quick as possible. We've also trended towards smaller units, which has driven down this per unit price. For a number of years that only intensified under COVID, we've had a catastrophic, huge rise in suburban properties. This basically shows that prices have doubled since about 2016, and we're up 25% alone in 2022. On the flip side of that, I looked at just City of Portland. This is all sales, City of Portland since 2016. Pretty modest value increases. We're up about 25% total since 2017, which is averaging about 4.2% per year. I think on this one, I excluded new sales, which kind of skewed the numbers way up. Moving over to Clark County, increased activity, record level values. I would have to think that Clark County has benefited from some of the increased regulation in Oregon. I know a number of investors who have never touched Clark County who have decided to make a few investments up there for the first time in 2022 and 2021. So with the interest rates moving so quickly, I think the first question I get on every single inspection is, how are values holding up this year? How are they showing significant declines? And my answer is that there's just not enough market data out there to really make a conclusion one way or the other. But this is actually monthly sales data. This is all sales 5 units and above in Portland Metro. And as you can see, transactions, they definitely slowed down. But again, 21 was the busiest year of all time. There's nowhere else to go. Cap rates, we were trending down for a long time, but 6 out of the past 7 months are showing, or 5 out of the 6 past months are showing a slight increase. So we may be trending up there. Median price per square foot, it feels like we're stable or maybe trending down a little bit. And then it kills me that they use average, but I can't change it. But average price per unit has also maybe been trending down, but I'm not sure I would put my life on it and say that based on this data to make any kind of conclusions about where values are headed. So if I had to make a conclusion from this, I'd say at best right now values are stable. But given the headwinds, I think it's safe to say that in the near term we're going to see limited value increases, maybe if any value increases. I mean, if I just told you these 5 data points, it's hard for me to think of a reason why value should be increasing. So interest rates up 300 basis points over the past year, vacancies trending up, rent growth slowing, likely recession, and limited to no population growth. I think just with those 5 data points, it's hard for me to make a strong argument of why values should see significant increases in the year ahead. I just pulled a few sample sales just to kind of give you guys an idea about what's selling right now. This is a 22 unit out in Raleigh Hills. It just sold for $256 per unit. It was a value add play. This is a 6 unit over in Beaverton, right on Allen Boulevard. It just sold for $157 per unit. This is another kind of long-time ownership play in Gladstone. Just sold for $138,000 per unit. It's a new property in North Portland. Just sold for $264. Little property out in Forest Grove, 9 units, just sold for $114,000 per unit. I thought this was kind of telling. I want to show you guys this one. This is a property called Park Place over in North Portland. It sold in 2018 for $181,000 per unit, and then it just traded in September of 22 for $163,000 per unit. So if I had to give a forecast for the near future, I think it's going to be a nice way to say it. I guess an uncomfortable return to the mean. I think we've, maybe like you guys like me, but I've had a lot of time recently, and I've read a few more forecasts, and it just seems like in the past 4 weeks, it seems like some of the opinion about where we're going with recession, it seems like the idea of a soft landing is a lot more feasible right now. I just had a report my inbox before I left, said that the Fed actually may be threading the needle on this and may be able to take us in to slow inflation without completely killing the economy, which is definitely a little more positive than I've heard in recent months. No, but again, so we had a full recovery in August of 22. The state of Oregon is calling us for us to shed 24,000 jobs by the end of 24. They're calling for a mild recession, and they're thinking that the unemployment is going to hit 5.4% at the max. Thus far, apartment fundamentals, they've remained strong. Vacancies are going to return to a more balanced market. We're going to see continued rent growth. It's going to be a lot slower than we are used to, but it's going to continue to trend up. I think the pain is not going to be felt in terms of owners and investors. I think the pain is going to be felt from people like you and me, who are real estate servicers, who we really rely on transactions for us to stay busy every day. And myself, brokers, title companies, lenders, I just can't imagine us having a stellar 2023 year given the way transactions are going. And I also think investors are, as investors are working through this market, they're definitely approaching these deals with a much more critical eye. I think this idea of buying on future upside with some kind of cap rate that is 18 months out with 12% rent increases. Because people aren't going for it these days. There's just a lot more critical eye on how the deal is operating right now. Back in the fall, in November, I was working a deal, and before it closed, before their special contingency was up, the buyer came back and wanted to retrade the price 8% lower. Nothing physically wrong with the property, no big changes in the books. It was just simply changing economic conditions. And so the buyer asked for that, and the seller agreed to it. So it ended up to be an 8% price reduction and a 30 basis point increase in the cap rate. And I think what we said before, I think we have a gap right now between buyers and sellers. Buyers are looking at interest rates that they're getting from their bank, and they're saying, and you got sellers that are pointing to deals that closed in June, July, and August, and saying, well, that's where my value is. So if I'm not hitting that, I'm not going to sell. And to be honest, there's not a whole lot of motivation for these owners to sell right now. A lot of them don't want to. They're unwilling to accept a higher cap rate right now when the property is still performing pretty well. And I just don't see a lot of discounted properties coming to market. I've heard of some institutional buyers, syndicates that are really cash heavy, that are waiting for blood on the streets before they go on some of these buying sprees. But I just don't see it happening. It might happen with some of these new apartment construction, where they took out a little bit riskier loan just to get the deal moving quickly. And when they go to refinance, it's going to be a different environment, and that loan is not very forgiving. But again, like I said, current owners, there's just not a whole lot of motivation right now. There's not oversupplies in the market. Rents are increasing, vacancies are reasonable. If you didn't buy in the past 24 months, you have a ton of equity in your project, and you probably have an interest rate a lot lower than there is right now. A buyer, actually, I got this from a buyer. They said, I'm not sure we're quite ready to consider a sale at this time, as our fixed rate loan does not come due for 2+ years. Plus, we're in the process of getting some higher quality / higher paying tenants. So we're in no hurry. But that just seems like the general mood of the market right now. It's just there's no hurry to go out and sell at a discounted price. I think activity will normalize, but I also think that a 3% rate or a 3.5%, 4% rate, whatever it is still so close in the rear view that a lot of owners are unwilling to accept the newer rates today until we get a little further past those low rates, and maybe they're forced into a position where they have to refinance or they have to sell. My biggest concerns for the next couple of years, I think we're 2.5 years into COVID, and I think it took salt and straw threatening to leave the urban area to really see any real action from this city of Portland about getting motivated to clean it up. And I think that I think a lot of the damage has already been done, reputational damage, and I think it's going to take a little while for us to dig ourselves out of this hole. I do have concerns about some of this rent regulation, on whether they continue to go in and tweak the dials. Maybe they move back the exemption for new properties from 15 to 10 years, or maybe they reduce the, right now it's 7% plus CPI, maybe they reduce it to 5% plus CPI, or just put a cap on it. I've heard 9.9% as a potential cap. Major concern is this changes in population. I think it could be very scary if we get to 2023 and we see continued declines in population. I think, as Josh Lehner put it, that's the 5-alarm fire time. And it's really, is it, as Josh put it, is this a temporary disruption of population, or is this a fundamental shift? And that's the big question that 2023 is going to answer. Higher interest rates, I think they have to start putting some upward pressure on cap rates. I think when we start getting more sales, we're going to see some higher cap rates there. I think another question for the coming year is, can higher net income offset any of these increases in cap rates? So we'll see there. What I'm optimistic about, I pulled sales data going all the way back to 1988, and despite all the different economic conditions with interest rates, whatever's occurred, Portland has only seen a few instances in those times where values were flat or down, and they never lasted more than 1 to 2 years. That just shows the strength of our market and the stability of our market. CoStar is actually maybe a little more positive than me, but they're forecasting, well, maybe not that much positive. They're forecasting modest gains in the years ahead. If you do the calculations, they're thinking about 2% per year in value gains through 2027. I'm not sure anybody wants to hear 2% gains when we have inflation running at 6.5%, but that's what they're forecasting. I also believe that Portland is more attractive to people who don't live here than people who live here. And I think from an investment standpoint, and I think that ULI survey that was consistently that the national perspective of Portland was 20 points, 20 cities above what the local perspective was. So I think sometimes we get so caught up in what we see and that graffiti on the side of the highway, but I think we fail to realize that a lot of big cities are experiencing similar struggles that we are. I think Portland's been publicized more about it, but I think a lot of the struggles that we have are being experienced by other cities, so we're not alone in what's happening. Strong fundamentals, they're still strong. We're going to be stronger than the U.S. as a whole in terms of vacancies, and those fundamentals don't change overnight. And the last one, I ended at the same thing last year, is that 2022 was the second or third busiest year of all time in terms of sales. These are purchases by national companies that have economists, on their staff full time. They're a lot smarter than me, a lot smarter than all of us in this room. And I really think that when they are investing here, that's a bet on the future of Portland. So as long as we continue to see national investment here, I'm confident that Portland's going to pull through and improve in the coming years. So I'm happy to take some questions if you guys have it. Otherwise, that is everything I got. Not yet, but I can put them on there later today. There's the website. Well, not the website, but barryapartmentreport.com, and it's all of our presentations and all of our reports are on there. So.
Is this where you get to the good news now?
Yeah. I wish.
The good news for Patrick is he gets a bottle of wine to take home to ease some of that pain and brain damage with all of us. So, Patrick, thank you so much for the wonderful presentation, great information. If anybody wants to get slides, please reach out to Karen. They'll be disseminated through the chat.
Great, thanks very much.
Thank you, sir.
Yeah.
Patrick, it's always interesting to hear what's going on in the multifamily world. That's why I'm multifamily. I stay in retail. But keep an eye out for a whole bunch of events. We're working on a bunch of new events that are out there. We're going to be doing our get-togethers every quarter, so keep an eye on that. We're doing everything from axe throwing to just gathering at different bars, so keep an eye on that. And then other events coming up in March, April, May, and June. Everything from public-private partnerships, financial focus, opportunity zones, and we're looking at bringing in Ted Jones. So keep an eye on that. Have a good afternoon, and thanks again, Patrick, for coming. Thanks, guys.